I do have a couple of questions that have already come in, but I want to start off first with talking about the PowerOptions tools and the search criteria on PowerOptions. Now, one of the patented tools that we have is the search tool for finding trades. And the search tool supports over 23 of the most commonly used options strategies, everything from debit spreads to credit spreads, condors, covered calls, buying calls, straddle strangles, married puts, and so forth. Now, each strategy has a few PowerOptions default screen already programmed into the search. You might see a name such as initial values. It's just a basic starting point, sort of a stepping stone for you to create your own search. You may see other searches in there that are themed searches for a given strategy, weekly searches and strategies, mainly, of course, income strategies, covered calls, naked puts, credit spreads, and you might see others in there as well. Now, the default searches you can use as a stepping stone to create your own personal search based on your risk tolerance and your goals for the strategy. You can create many searches in each strategy, save them, and then actually have those results emailed to you at any time. Well, let's navigate over to PowerOptions right now, and we're going to take a look at what I might do in a given strategy, what I might look at in a given strategy as relation to the default criteria. All right, so apologize there. Let's switch on over now. There we go. Okay, let's see, did that come through? There we go. All right, so what we're looking at here is the default PowerOptions 14-day free trial screen. Those of you just getting started, I encourage you to take advantage of the 4 steps that are listed here. You see you can, of course, download the free quick start guide, just access the PDF. There's some flash tutorials to help you get familiar with the site. There's a variety of free webinars, archive webinars, and live webinars that you can access during the week at any time. And of course, you can sign up for a free coaching session to have a 35 or 45-minute conversation with myself or Ernie. Now, as I'm starting out on a trial, I might be interested in a particular strategy. We see here we've got some of the strategies listed: bear call, long call, calendar put, and more. If you don't see a strategy you want, simply click on the Other Strategies tab on the top navigation system over here on the right. And you can pick and choose which strategies you wish to search, analyze, or find positions for. Now I'm just going to go to bear call credit, and I'm going to go into the search tool. And this is going to pull up a list of potential bear call credit spreads, not directly recommendations or suggestions. We scroll down below the listed trades, and below the listed trades is the parameter field where I can set the different criteria for my needs. Now we have tools to get you started. Here's that initial values. It's a default set of criteria. A starting point Ernie and I might use if we were interested in trading monthly bear call spreads that expire 1 month out in time. And you can customize various options criteria for range in the money, out of the money, delta, probability, and more, as well as stock technicals, beta, percent of 52-week range, stock volume, volatility, RSI, Bollinger Bands, MACD, SMA 20, and various fundamentals, underlying stock price, earnings per share growth, screen for earnings date or earnings dates not between now and the expiration, ex-dividend date, market cap, and a lot more. Now, as I mentioned, there are other default searches here as well. We have initial values, bear call number 1, which is a subtly different tweak, and there is usually a description underneath one. The weekly bear call credits and bear call credits on the VIX, something that you might use in a bullish market that Ernie put together. Now, when you pull up a search, you scroll down below the listed trades, you're able to see the active filters that are used for each one. So this default initial values, we see that we have an expiration to the next standard expiration month, a minimum net credit of 50 cents or more, 5% return or higher, at least 10% out of the money, an 80% probability, stocks in a downtrend, and of course avoiding earnings between now and expiration. Now, if I wanted to do a weekly search, most likely I would just select the weekly bear calls here from the drop-down and make adjustments to that search. I could do it from here as well. For example, I could just take the all expirations time frame, and I could say I just want to look for positions that expire in the next 2 to 15 days. And since I'm going shorter term, I might adjust my net credit a little bit to 20 or 25 cents. And I could still probably go 10% out of the money, but I'm going to go only maybe 8% out of the money and keep that 80% probability as well. Still looking for a stock in a downtrend, still looking for a stock price greater than 15. I could add other filters. But in any case now, let's just submit that search. See if we get any results based on our new criteria. All right. So we still have some positions that expire 14 days out. Tesla is dominating based on the premiums that are available. Of course, maybe the volatility as well. Now, if I'm comfortable with the results, I'll just save this search now, and I can call it My Weekly Bear Calls, and I could put in a brief description. And then we'll click Save this search. So now anytime I log on to PowerOptions, go into the search, I can access my criteria or toggle back to the default PowerOptions criteria at any time. If you wanted to create a weekly bear call search on just ETFs, we could do that as well. Just wanted to look for bear calls on stocks that had a negative MACD crossover within the last 3 days, we could do that as well. We control the defaults, but you control any of your own saved searches. And then, of course, after you save any searches, you can select to have those emailed to you at any time by clicking the Get Results by Email button up at the top. The system will run your search for you. Let's say I selected it. Let's just go through that. I'll just click Get Results by Email. I'll select My Weekly Bear Calls, and I want it sent to me at 10 a.m. I'll click Save and Submit. So on Monday morning, 10:01 a.m., I'll receive whichever spreads match my weekly bear call search. The system will run it and then send it out to an email for me. All right, so I just wanted to review that real quick. The default searches are not direct recommendations or suggestions. They are the starting point that Ernie and I would start off with if we were opening a new position today, based on the time frame, based on the theme of that search as well. But you can customize this any way you want to just find positions that match your return as well. And then you can select to have those emailed to you at any time. Okay. Let's see here. Good. All right. So I've got some questions here from, I think it's Chucky, it says. And I've got, Bin's got a couple questions. We're going to start off with Gordon. And Gordon asks, what is the max loss on a bull call spread? Okay. A bull call spread is going to be done at a debit. It's a bull call debit spread. So let's clear out long caller for the time being. And I'm going to add in bull call debit. Let's go ahead and save that. And as we just did, I'm just going to take the first one. Gordon, let's go to bull call debit spread. I'm going to go into the search. Now there's two ways to go about this. This is a weekly bull call debit spread search 7 days out in time, where we're going slightly in the money with both options for a higher debit on the position, which also entails a higher probability that we'll get the maximum profit. So I'm just going to take 5 here at the bottom. Not a recommendation or suggestion. The stock's at 126.54. And I can sell a 123 call for around 450 and buy a 120 for around 730-ish. Let's go to the profit and loss chart for this position. Oh, sorry, there we go. Now, using the midpoint prices here, we see that I could get about 470 for selling the higher strike call. I'm going to pay 710 for the lower strike. This would give me a net debit of 240 on a 3-point spread. If the stock stays above 123 at expiration, both calls are in the money, Gordon. I'll be able to buy shares of stock at 120, sell them at 123. I've got to meet that obligation for the option that I sold, and I'll get the 3 points back. My cost was 240, get 3 back. Our profit is 60, so we make a 25% return as long as 5 stays above 123. Your question is, what is the risk? It is the net debit that we paid into the Bull Call Debit spread. If I'm wrong on this position 7 days away and FIV drops to 119 or 118, by next Friday, the 15th, what would happen? Both calls would expire worthless. I get no value back, and my loss is the debit. Your net debit is the maximum loss, assuming no other management. Now, what do I mean by that? What I mean by that is that if I entered in this Bull Call Debit, of course, have a debit of 240, the stock falls, and for whatever reason I say, okay, you know what, let me kind of sell this 120 call because I'm worried that it's going to go to 0, so I sell it for 50 cents. Well, now my debit's 190, my risk is 190, but I've got a naked call open because I canceled this. And suddenly the stock gaps back up to 129. Well, now that's a 6-point loss. Leaving the structure alone to expiration, your max risk is the net debit you paid in the position. In this case, it's 240. We hit the max loss if we allow both options to expire worthless if 5 dropped below 120 at expiration. Another popular way to do Bull Call Debit spreads, Gordon, is to go further out in time and sort of straddle the stock price. What do I mean by straddle it? I might sell a slightly out of the money call, 127, 128, and buy a just out of the money, in the money call, 125, maybe 126. This gives me a low debit, but a chance to have almost a 1-to-1 risk-reward ratio. So let's give ourselves some time for the stock to move in our direction. Let's go out 21 days to March 1st. And it's close. Let's try this. Let's try the 127, 125. It's only a 2-point spread. We're going to still sell the higher that's at just slightly out of the money, buy the option that's slightly in the money. Okay, we get a debit of 115. So midpoint, we get 395 for selling the 127 call. We pay 510 for the 125. One thing I should have said earlier, because this is a debit spread, I don't have any margin requirement. I am obligated to deliver shares of stock at 127 that I don't own, but I have the right to buy them at 125. So there's no margin. If we were in a bear call, if we sold the 127 and bought the 129, we'd get a credit, and I'd have to cover the difference. That margin requirement would be my true risk. But here in the debit, what we pay is the only requirement, and that is our maximum loss. This is sort of the out-of-the-money Bull Call Debit. If the stock goes above 127, we get the $2 back. We make an 85-cent profit on a 115 investment for about a 74% return. The stock falls below 125 in 20 days. I don't manage it, hold it all the way to expiration on March 1st. It's below both strike prices. Both calls expire. We lose 115. You'd probably manage it before then. That's kind of the goal in this strategy. You want to make sure that if it starts to move against you, you can adjust the position. You don't want to take the full loss if possible, but sometimes that happens without your input when there's a sudden drop in the stock as well. What is the difference? Let me say this. What is the main difference between the first spread I showed with selling the 123 call? Oh, I'm sorry, I'm way over here. Selling that 123 call and buying the 120 for only that 25% profit. Well, remember the stock's at 126, right about here. Oh, I'm sorry, it's a green line right about here. So this position is only a 25% profit, but in order for it to start losing, it has to drop below 123. As long as it stays in this area or moves up, we make the full profit. Have a reasonable probability the stock would stay above 123, probably closer to 70, 75, maybe 80% or higher. This out-of-the-money bull call that gives us a better or a closer to almost one-to-one risk-reward ratio. Instead of paying $240 to make $60, we have a lower probability that the stock will be above 127. Now we are bullish. We're taking a one-to-one ratio, but this probably only has a 45, 42% probability the stock will be above 127 in the next 21 days. So it's a balance of probability versus risk and reward. But in either case, the maximum risk in a debit spread is whatever you pay into the debit. It's also true for the diagonal spreads. But again, you really only lose the full debit if you hold the position all the way to expiration and the stock is below your long option strike price. All right, so that's covering the risk of the debit spreads and the structure. Although I might do this with a debit spread, this is a bull call debit spread. A parity to a bull call is a bull put credit, has the same risk reward profile. But as you've heard me say before, I would never do this structure where the option I'm selling is higher than the current stock price in a bull put credit spread. That would mean that my short put is in the money and I can be assigned at any time. And if I'm assigned early, I'm going to have to manage it differently, and I may have to have the capital on hand to do that. I will straddle the stock price with a bull call debit or a bear put debit. I won't do it this way with the credit spread. My credit spreads are always out of the money. Both strike prices are out of the money, looking for a probability of 80, 85% or higher. Okay? But that's your risk. It's what you pay into the position. All right, now this is Bin's question here. He says, I'm sure this topic has been covered before. Can you explain how to manage a naked put position by rolling? Without taking assignment, of course. All right, well, absolutely I can, Binh. We can cover, some of the management techniques we would use for a naked put trade. Sometimes you can't avoid assignment if it's a sudden drop. And I don't think Penn is one of those. T-Rex is not one either. But I'm going to try Penn. It's a strategy I traded a long time ago, a position I traded a long time ago as a married put about 1.5 years ago. I just want to take a look at the price for Penn here. Oh, okay, we'll go this route. Now let's just say a couple of days ago we sold the 26 put a couple weeks out in time. And now, of course, the stock is falling and is now down to 25.05. It's stagnated, but let's say we are very bullish. But here we are in a situation. Okay, so what I want to do is let's just go to the option chain. And let's go out a couple weeks. Oh, this is just all for standard. So we'll stick with February 15th. Why not? I'm going to take the 26 put and I'm going to add it to the portfolio as a naked put position. New portfolio, let's just call it first of, you know what? We'll call it Friday of 2019. Okay, so this is going to be our Friday portfolio. Let's just say we sold 5 contracts of this. And when the stock was a little bit higher, let's put 145 in, okay, 2 days ago. All right. Okay, so here's my naked put. I sold a 26 put for, I meant February. It's okay, it's March. But now it's down to 25.05. What are my options here? Well, the first thing I do whenever I set a position, naked put, bull put credit spread, is I'm going to set a trigger. So if the stock reaches within 1 or 1.5% of my short put strike price, I'm going to look to manage it. So I probably originally would have clicked on alerts there, and I would have set a lower limit at about 26.25, let's call it. Just mark it as red, so that tells me I need to manage the position. And then I could also set things if I'm within a few days to earnings, I could set an alert. Stock has changed, moved below its 20-day or below its 50-day. All right, let's go ahead and save that anyway. So now I've got an alert. It's been triggered. There are multiple ways you could manage the naked put position. My first instinct here, now that it's dropped below my short put strike price, let's say it opened today $1 down. It blew right through my trigger at 26.25. Okay, and it fell $1 at the open, or $1.20 at the open, $1.50 at the open, whatever. So it's at 25.05 when the market opens, well below where I wanted. Well, to avoid assignment, and this is March, so I may not be so worried about early assignment, but if it was the February series, I might be a little bit more concerned. Well, the first thing I'd be tempted to do is roll the put down. Okay? Now, and just say, okay, so it's at 25 now, let me just roll down to the 24. But now which expiration and which one makes sense? Let's take a look. So I'd go to position actions and then position analysis. Anytime I'm tracking a position, I can go to this analysis view. It gives me a breakdown of my original position, what my current loss is now. Of course, if I held it for another 35 days and the stock stayed exactly where it is, I'd still have a small profit because we took a lot of premium inside. But now here it does show me rollout opportunities. We know that it's going to cost us $1.85 to buy back our current put. Remember, we collected $1.45 for it, so at a 40-cent loss. But I could go to the April 24 for $1.15. It still gives me a positive net credit of 75 cents, or 3.1%. I drop lower to the April, which is going to extend the time. Right? We're going 69 days out as opposed to 35 we are in March. It still gives me a positive return, but a smaller net credit because I'm only taking 85 cents back. Could, of course, roll to the 25 put for April, keep the same expiration, still keep a positive net credit, and if it stays above 20, if it moves back up above 25 and stays there, I could have 4.8% return. Okay? Now, whenever you're analyzing a rollout opportunity, of course, it's good to see the numbers, but then we can also click the More Information button, go Simulate Trade, and we see a side-by-side comparison, my before and after picture. Here's my position right now. Unfortunately, as we saw, to liquidate now is a 1.5% loss. If we hold it to expiration and stock stays at 25.05, we saw it was a 1.9% gain. If it goes back up above 26, we make 5.9%. If I roll down to the 25 strike, I still keep a positive premium. I lower the return, but now it's right at the money. I might be tempted to go with the 24, but it didn't come up because it wasn't keeping a reasonable profit to roll to the 24 strike. Okay? So to avoid assignment, you could roll down as well. Another option you could do is plan on it coming to a covered call. I'd only look at this in the last 2 or 3 days if I haven't adjusted it yet. Plan on taking assignment and convert it to a covered call. We show those too. I'm not addressing that with you right now, Binh, because that wasn't your question. You wanted to avoid assignment. Now, that's just the straightforward approach. There are other ways that you could, there are other ways you could manage this position. So let's just go to the profit and loss chart. The initial instinct is to, just as we saw, and we do the work for you on the portfolio, covered calls, any of the strategies we support, you'll be able to see rollout opportunities, any of the strategies that we support there that you're tracking in the portfolio. But the main idea is just roll it down and to get better protection. Now, as we saw, you don't always have to roll for credit. I mean, the overall net credit was kept in all of our examples. Let me go back one step. Oh, here we go. I'm sorry, folks. So remember, I could buy this back for 185 and sell the April 25 for 160, the April 24 for 115. All right, but right away you'd say, oh, that's rolling for a debit. I'm paying 185, but only getting 160 back. It's all still a credit. keep in mind what you originally took in as well. So you don't necessarily have to roll for a credit if the new return still matches your goals and gives you a better probability and better safety for the position. Okay? So you don't necessarily have to roll for a credit. It helps. But if I'm buying this back for 185 and I want to go a couple strikes out of the money to keep that sort of 2 points out in protection, I may have to go out to July. Yeah, see here the 23 is right at 170 to 185. The 24 is at 210. So I'm buying it back for 185 and selling a July for 210. That's rolling for a credit. But now I'm all the way out to July. So I could still make an 8.4% return. That's pretty good, but that's not for a 1 month trade. That's 8% over 161 days. Might not be worth it to try to roll for a credit in that case if you can still keep a 3, 4, 5% potential return in the same month you started off in. Now, if I was expiring today, I'd naturally have to go out 2 weeks or 3 weeks. But again, don't necessarily have to roll for a credit. We saw some good roll opportunities. March might not be as good. Yeah, you're only getting 70 cents. Let's see what this would look like. All right, we took in 145, buying back for 178, rolling down to the March 24 now for about 70 cents or so, 78 cents. So this would still keep us at a 1.9% return. Right now we have a 1.5% loss. So this is a good roll in my opinion as well. Keeping the same expiration, moving down a couple strikes, still could net a 1.9% yield in 35 days, give or take, as long as the stock stays above 24. Of course, now the debate comes in. Well, the stock was moving against my direction. Do I want to just roll to another naked put on a stock I thought was going to be bullish, but has now started to decline? If it keeps declining, I'm just going to have to roll this one probably out to April, and then I might have to roll again to the lower strike, and then who knows? Want to make sure I'm going in the right direction with the stock for this position. Now, Binh says close half of the short position. Well, you could, right? So I could buy, in this case, let's buy 3, not quite, a little bit more than half, Binh. Okay, so now I only have 2 contracts open on the position, but what does that mean? If the stock's going in the wrong direction, I still have 2 contracts open where the losses could quickly start to outpace the other obligation I had. Yeah, I did start off with 5 contracts at 26 strike. Now I'm down to 2 contracts at a 26 strike, so it's $5,200 only. I could still make a profit of $191, but if the stock continues to fall, I'm going to erase that very quickly. Okay. All right, so let me clear that out. Let's go back to our main position. Okay. Is it always a good idea to keep rolling down? Not necessarily. Okay. We talk about this with covered call investors a lot, and keep in mind this is essentially a covered call. You have a margin requirement that's equal to, if you bought the stock outright, 500 shares. You did take some premium in that capped the upside, so you have a known gain up front. If the stock continues to fall and you keep rolling down in a covered call or naked put, you're always losing more on the buyback cost than typically you're going to gain on the roll cost. Unless, as we saw, you go 6 to 8 months out in time. Now you're looking to make 1.5% yield on a position that's going to take 6 months to get to that full 1.5% yield when the put expires. Does that match your trading plan? It probably doesn't. Okay. So the idea with a covered call, which has a similar risk-reward profile, is that as the stock's falling, what does the stock have? Delta of 1. So you're always losing more on the stock than you're gaining by rolling down the call. Okay, so if it keeps falling and keeps falling, You're losing on the 8-bill. Will it eventually come up? Maybe, even on a stock like Apple or something else along those lines if you're rolling down a naked put. But again, the problem comes now is that every time you roll down, you're giving up more and you're lowering this return. You're never going to increase this return unless you went a year out in time. Now you're sitting on that margin requirement for 12 months, and if it keeps going down and keeps going down, you just keep ignoring it. Well, it might recover eventually by the end of 12 months. It might not. It's a tough thing to sell. Could you be using this margin requirement somewhere else on a stock that is going in a trend for a bullish strategy, or get out of this position and do a bearish position on something that is bearish, such as the stock you're in? Okay. Is it a good idea to buy an option as the stock is falling? Not necessarily to protect it. You would have done that first. Okay? What do I mean by that? You entered a position that you were neutral to bullish on, that you felt the stock was going to move up and your put was going to expire worthless. That's the end game. Now it's moving against you. I can add a put to stop further losses. Let me go out to March now. Let me buy the 24 put. Keep it even. Buy 5 contracts. This creates a bull put spread. But what's wrong with it? If the stock keeps falling, you've minimized the loss you could take, but you're still at a loss. Oh, sorry, folks. The stock could recover, and of course, you've greatly reduced your margin in this case. I'm not saying this is a bad idea, but you see where I'm trying to get at, Binh. There's probably 6 to 7 ways you can manage a naked put. We teach 8 ways to manage a bull put credit spread. There are probably even more we don't get into because they add to the complexity of the strategy. If I'm in a naked put, as we saw, and the stock starts to fall, I may consider rolling down the put. The first thing I may consider is, number 1, do nothing. The stock fell. It was from some outside market condition. I think it's going to recover. In this case, with the pen position, the original pen naked put, my risking assignment, yes. Rule number 1 of a naked put position: never sell a naked put on a stock you would not want to own long term, because that is the potential outcome. And it could happen suddenly. If this, as with pen, if it suddenly fell today, it's at 25.05. Buyers of the puts on the other side, they all panicked and decided they wanted to cash out now. They sell to close their puts. The market maker has to make things even, so he starts exercising the short puts. I get assigned. I would want this to be a stock that I would want to own in my portfolio long term. I could treat it then as a covered call. It's not a good idea to sell naked puts just because they have the best premium and the stocks are more volatile if you don't want to own the stock. That could come back to haunt you. All right, but anyway, let's go back. Number 1, do nothing. I think it was an outside force. It wasn't anything related to weakness in pen, any pending news or anything. I think it's going to recover and still be profitable. Number 2, the obvious one, roll it down. As we saw, look for positions. It doesn't have to be rolled down for a credit. I don't have to take a credit for the roll, but overall I need a credit, meaning that the initial premium I took in minus the buyback plus the new premium definitely has to be positive, and I probably want this new premium, this new strike, to be 1 or 2 strikes down. So I could buy to close my initial, roll down lower, hopefully keep the same expiration, but I might have to go further out in time. If you have to go 4, 5, or 6 months out in time, that might not be worth it to keep a profitable position. Number 3, you could do this. You could buy a lower put to create a bull put credit spread. You didn't solve the problem that you could still have a loss, but you've reduced the margin drastically. You've reduced the maximum risk to that margin requirement, and if it recovers, you'll see a nice percentage return on the new margin as well. But if it keeps going down, or even if you roll, as you had mentioned, if it rolls down and you keep going down, then you may be in for larger losses as well. Okay, but this does hedge it. It cuts the margin down. It cuts the risk down, but it hasn't solved the problem. Number 4 if mathematically possible. And these are slightly out of order, and I'll show you why in a minute. Buy a higher strike put, not a lower, buy a higher. Why? Here's a position that you're neutral to bullish on. Stock is moving in the opposite direction of what you want. Buying a lower lowers the margin requirement, gets you a high percentage return, but you could still lose if the stock's falling. If the premium is available, rather than, I know I'm trying to keep the drawings there so we keep this, but I'm gonna rewrite them all so it's easier for us to see. Like to keep them there, but we're not going to. Now that it's fallen, if possible, if I could buy a 28 put, remember I took in about 145 here, I'm going to pay about 320. Well, it's going to be close, but I'm going to buy 5 here. Okay, and in this case, what did I do? Well, the opposite of what we started with the Bull Call Debit. I've now created a bear put debit spread. Okay, in the direction the stock is moving. I lower the maximum risk. The maximum risk is now if the stock goes above 128, I could lose 875. But if it stays below 26, I can sell to close the 28, buy to close the 26. I'll get about $2 back. So I'm sorry, get about $2 back times the 5 contracts would be $1,000. So that's $125 profit, 14.3% return. I turned a bull's naked put into a bearish position on a stock that was moving against me. Okay, so that's another alternative. So let me write it down again. 1, do nothing. You risk the assignment bin, and that's what you told me you wanted to avoid. So this is almost another reason why I didn't want to talk about this. Is almost like saying plan on getting assigned and converting it to a covered call. But in your question, you'd mentioned you wanted to avoid assignment. Okay, so right now we wouldn't do nothing. Number 2. This should have been number 2. I forgot it at first. It's another obvious one that no one likes. But close the position, take the loss, move on to another naked put position on a stock that is going your desired direction. Why do I say that? If you're using naked puts in your portfolio and you don't want to be assigned, if you're trading multiple positions, even just 3 or 4 positions on different stocks, over the course of the year, you're going to be wrong on 10 to 15% of those. You might have an 80, 85% success rate on your naked puts going 8 or 9% out of the money with that 85% probability. You're going to take losses. It's okay. The idea is to limit the loss on the losers to keep that win ratio that matches your trading plan and still profit what you need, 75, 80, 85% of the time. Close position, take small loss, and just move on. Okay? Number 3, roll down as we mentioned. We saw some of those, and in some cases, if the stock falls suddenly and unexpectedly overnight, you went to bed and your naked put was 3 or 4% out of the money, the stock fell 10%, now you're 7% in the money. In that case, in order to roll to keep any profit, you are going 4, 5, or 6 months out in time. And it might be converting an 8% loss to just a 1% gain. 1% gain over 8 months is probably not going to match your trading plan, or 6 months, or 5 months even. But again, look for opportunities to roll down, and remember with this one, it's the trigger points. You would typically want to roll or adjust the position when the stock reaches within 1 or 1.5% of your short put strike price. Okay? All right, so do nothing. Close the position. Roll down. Buy the lower put to cut the risk, create the bull put credit spread. Okay? In that case, we saw that we'd drastically reduce the margin, still could have a profit on the position. So you'd create the bull put credit spread. Risk and margin is reduced. You could still profit if the stock recovers, but if the stock continues down in price, you haven't done anything to correct being in a bullish position on a stock that's now bearish. Number 5, as I mentioned, buy higher strike put to create the bear put debit spread if the numbers work out. If the stock keeps declining, you've got a profitable vertical spread on your bear put debit. Okay, that's another alternative. A couple comments came in and said, oh, you could do a butterfly, you could do a ratio. Okay, you could, but doing a butterfly position, trying to convert to a butterfly, or trying to convert the naked put into a short strangle, gives you now two ways to lose if the stock recovers or if it continues down potentially. Simply selling a call, it would increase the premium, but now you have two ways to lose and the margin skyrockets. Converting to a butterfly, just like the bull put, it might control the risk a little bit, and then you add a bear call or something on this side to create the butterfly. Margin is now an issue. Not really, it's two credit spreads, but it still might be an issue. And at the same time, you have two ways to lose, and you might not have repaired it even if the stock stagnates. Okay, so that's why I don't really mention them, because it's based on, they could be used, don't get me wrong. They could be used, but you're changing the whole complexity of the strategy into something new. And that might not match your risk reward or your margin requirement for the position. Now in the iron condor, I should say, or the iron butterfly, it would free up margin just like the spread does. Because you sort of convert your your naked put to a bull put credit, and you'd add a bear call, but now you still have two ways to lose. And you might not have made too much of a gain on this side, so it could still be a loss as well. And that's just some of the extra stuff. And someone says you could convert it to a ratio back spread. Yes, I could buy twice as many puts down here, or twice as many puts up here to convert it to a position that has infinite gain if it continues down. But again, is that what you're looking for? Is that the strategy you want? Real quick, number 6. I don't talk about it either in this case because Binh didn't want it to happen, just like sort of number 1. But number 6 would be allow it to be assigned, convert it to a covered call or a collar spread, and manage it going forward. But you had mentioned that you did not want to take assignment, so we wouldn't even look at those opportunities. All right, let's clear up those drawings. Those are sort of the 4 or 5 ways to manage a naked put position. Good review, great question. One last thing on this topic before we move on. At any time, you can go to the free webinars. Remember, it's powerop.com/webinars.asp. Under Option Strategies, going down to last year, I know it's here, Introduction, Managing Your Naked Put Positions. Oh, I'm sorry. This is the one that's almost 4 years old exactly right now. It is 4 years old. We have a more recent one. It just hasn't replaced this one. It's available, I think, in one of the other sections. It might be on YouTube. I'll try to find that link for you, but we'll get that updated for you. This presentation, actually, the recording was better. So I kept the 2015 version as opposed to the 2017, I want to say it was. But we'll look at that again. It's a good review. We'll cover it again. All right. Let me go back. I've got other questions from Sam. Starts off, he just says, good afternoon to everyone. He actually wasn't trading today. He wasn't placing any trades. He was managing his spread positions. Straddles and SKX, Twitter, and BOT. Okay. Something called Arconic was not profitable. All right. We covered Gordon's question there. All right. This is Charles. I'm sorry. This is Charles's question. Charles says, in the search area, I noticed IV over HV% is missing. It's crucial for selling overpriced options. I'm reading on here. Okay. So what you're looking for, Charles, is something different than what we show. Okay, now here's Charles's exact question. Anyone can chime in with his thoughts here or my answer to it if you think I'm wrong. And I'm not saying Chuck's wrong or Chucky's wrong either. So he says, in the search tools, I noticed IV over HV% is missing. Okay, I think you're looking for a percentile of historical volatility compared to the current IV. We don't look at that on Power Options, and I'll explain why in just a moment. Now you say this is crucial for selling overpriced options. I just started a trial and found this missing. Likewise, those buying options want to buy cheap options, so HV would be over IV for the percent metric would be under 100. Okay. Happy to accept a pointer from you if there's there to assist me. Thanks. All right. We show two metrics for IV over HV and what's called IV over SIV. So if I go into long call, I want to look for calls to buy. And what do I want to do? Just as Chucky said, I want to buy something that appears undervalued compared to the historical volatility, and also where the volatility percentage is in the lower range of 100%. So if the volatility recovers, it works in my favor. It goes back to the norm. So I would look for undervalued options using the IV over HV ratio. We'd look for less than 1. I could even look for less than 0.90. I don't know if any of the calls that came in the initial search are going to match this, but that's what I'd put in. IV over HV ratio of less than 1. It's the implied volatility divided by the stock's volatility. I want it to be less than 1 for an undervalued option. When I'm selling, probably want that to be higher than 1. Rather than use the percent stock volatility, which I think you meant by the HV percentage, what Ernie and I use and we feel is a better metric is the percent implied volatility range. This is showing you where the option's implied volatility is right now compared to where it has been over the life of the option. Not in the last 12 months, when this series might not have even existed, when whatever strike price it is now might not have even existed. This is over the exact time frame of the option that would come up in the search that would be interested in trading. Okay, so from, let's say if it opened 6 months ago, it's the total implied volatility range. If it's gone from 0.2 to 0.5, and right now it's at a 0.4 volatility, we'd be in the upper 80 percentile. But I want to be at something that's less than, let's say, 0.45, under the 45%. So if the volatility goes back to normal and the implied volatility increases, that's going to benefit me for a long option. So I'm looking for options where the current implied volatility is less than the historical stock volatility, so it's undervalued, and is in the lower implied volatility range over the life of that specific option. Now there's nothing here that matches this criteria. Doesn't mean there's nothing there. It's just with the default criteria, there's nothing available. So let's clear all the filters out. I'm just going to let's look to April and focus on a low volatility, undervalued screen within the lower range of their implied volatility. And want to make sure we have some liquidity, that's all. And I don't want to pay more than $10 for an option. Simple screen. I'm not going to go in the money or out of the money. We're going to get a lot of results now. Okay, so we've got Mattel, the 10 strike for April, and so forth. There's about 100 results that are currently undervalued compared to IVHV and are at the bottom of their percent IV range as well. Okay. Oh, and you say you're usually selling. Now, that's a caveat. Okay, that's something different. Okay, now, so that's for buying. Okay, the IV to HV ratio is there. The percent implied volatility ratio is there. Earlier, we were in the naked put, and I could screen for the same thing. But if I was looking for premium, I might want the implied volatility range to be above 0.65, and as I mentioned, the IV to HV to be greater than 1. And let me just see in the long calls here. Let me get an example of that. Let's see here. Did I do that right? Yeah. Now, good price stock. Oh, let's try this. GLPG. Okay. I'm going to go to this. I'm going to go to the custom spread tool for GLPG. And view options, and I'm just going to go to February. I sell a 100, buy a 95. You wouldn't do this because it's an at-the-money position. Well, okay. And Chucky's comment is 100% correct. Where I was going, I haven't shown it yet, but what he was referring to is that on bull put credits, bear call credit spreads, linked positions, the volatility metrics are different. Okay, there's the implied volatility ratio of the sell and of the buy itself, but you don't have the IV-HV ratio for the sell option, and you don't have the percent implied volatility range for the short option. I'm going to try to get that in for you. Okay, it's something I have on the list in the programmers. I think it's in the lower end there, but I want to increase it. One of the reasons why that's not shown in the spread is, let's take this position. Now, it's not as out of the money as I'd normally go. It's a high percentage return here. Good, reasonable premium for the 100 put for February. Not too bad of a premium for the 95. Good net credit for an at-the-money bull put credit spread. We wouldn't trade this. But let me go here. I'm going to go to research, and I'm going to go to option research for our sold option. Okay, and the reason why it shows this is because for selling, it has I ran the search opposite, so I know Galapagos had these positions, but look, this is the numbers you'd be looking for. An IV-HV of 1.6. Okay, and a percent implied volatility range of 75% for the sell option. That's what you're targeting. I'm not disagreeing with you. That's a good thing to do. But let's look at the buy option now. Same expiration, IV over HV of 1.7, 70% overvalued on the option that you're buying as opposed to 60%, and a percent implied volatility range of 0.50, so 0.73. The total range is 0.596 to 0.934. Okay, so the option you're buying is right at 50%. The one that you're selling was at 75. The one that you're selling is 60% overvalued compared to the stock volatility. The one that you're buying is 70% overvalued compared to the stock volatility. Okay, why is that important? It's not that it's important, but the reason why we currently don't have that in there is that if the option that you're selling in a credit spread is overvalued and in the higher range of its total implied volatility range, the option that you're buying is 95% going to be the same exact thing. It is a wash. Okay, so even though the option you're selling has a high IV to HV ratio and is in the higher end of its percent implied volatility range, the option that's in the same expiration cycle and just 1 or 2 strikes below it is going to be exactly the same. It's going to be overvalued. It's going to be at the higher end of its implied volatility range as well, so it's a wash. Stock price of 101.53. Selling the 100, buying the 95 for 7 days out in time. Okay? Now, I'm just going to go back to bull put real quick. I doubt I'm going to find anything, but we're going to try. Nothing on the first page. I was hoping, but nothing there. So, all expirations, 1 to 8 days. Not going to worry about the ratio. Oops, sorry, I'm not going to worry about the return. So let's call it, well, I'm going to leave the return blank to prove my point. We're not going to go more than 2 strikes out of the money. I'm not going to worry about probability, but you know what? I'm going to look at a return for around 50. And last thing. Okay, so we saw Galapagos come in. And Ring Central is another one. Let me just take a look here real quick. That's probably up. Yeah, that's overvalued as well. Okay, let me that out. 1 second. I'm going to get with you in 1 second. I see your follow-up point, and I'm not disagreeing with it. Perfect. This is exactly what I wanted. Okay, so let's go to Kansas City Southern. Let's go to the profit and loss chart. What I need here, February 15th, Okay, all right. It was 101.53. This is at 102.22. Okay, so what I did for you is I essentially proved your point why it might be. This is interesting. Sometimes I see this. This might have been an extreme example, but it's okay. The position we originally looked at, remember, we were looking at a 100 to 95 spread, same as this one, same expiration, where you had a 1.6% IV over HV, and the long was actually more overvalued as well. And it was looking at close to a 49% return. So in this position, the options are opposite. They're not giving you as much premium. Why? Because the IV to HV is opposite across the whole board, right? So this one is telling you that the IV over HV is less than 1, meaning it's undervalued, and it's only 10% of its implied volatility range. And should have saved it. Okay, sorry about that. This one here, with the opposites only offering an 11.6% return. So, although the value of the short option was negated by the long option in our initial position on Galapagos, the net premium was 3 times what we're seeing here for an option that is undervalued and is in the lower range of its percent implied volatility range. Now, let's step back for one moment. Why is that? I'm hoping I still have it up, but I do. Good. Okay. One of the things... Okay, let me go back here. One of the things we didn't quite take a look at, go to quotes here. Okay, so this is after February 15th, so that's good, but it's healthcare. It's a volatile position. I'm talking about a bull put spread. It's been up to 110 and as low as 85, but it's been to 95 within the last month, come back up, been holding that line. But it does tend to swing more wildly. Okay, so this, compared to our boring position for a bull put credit spread, oof, okay, I wouldn't touch this right now either. So what is in an uptrend is what I was looking for, because I was just looking for the price. So okay, I wouldn't do this with a bull put anyway. Doesn't have as much wild swings, but it's going in the wrong direction. Okay, so we can talk about either way. We saw the difference between what KSU offers as far as the same strikes almost, not that one, but the 100 to 95, only 11% return, versus where we saw Galapagos there, had the higher implied volatility, did give you a better return. Then you have to pause and ask for yourself, why are we overvalued? All right, so I want to look for the good return. You're absolutely right. I want to look for the position. Is that weekly bull puts that came up? I want to look, no, it wasn't weekly bull puts, I'm sorry, but I want to look for the position that has the return that I want. But if it's something that seems so high, 49.3% I think we saw, there's usually a reason. It could be in anticipation of the earnings, which are actually coming up after that 7-day screen that we looked for, Charles. It could be that, and that would be okay if it did expire afterwards. So your other comment here says, maybe I should be looking at the technicals as well. Absolutely. I think you need both. I want something that is going in the desired direction, does not tend to swing wildly, especially when I'm doing a spread that may be as high as an 8-to-1 or 7-to-1 risk-reward ratio as well. And of course, skip the earnings. I didn't do that, yeah. And you also mentioned, see, let's go, I'm going backwards here to Charles's other comment here, and we're on the same path here. So I don't want to skip the underlyings. Okay, I don't want to skip the technicals. I always want those to be in there. And in one of the webinars we recently did, we showed that might not be the criteria you want, Charles, but we showed if I took a successful search criteria that we use in the Bull Put Weekly, where I'm looking for an 85% probability, 14 days out in time, avoiding earnings between now and expiration and so forth, and I wanted a stock in an uptrend and a positive MACD. We tested that over a one-year period starting on January 1st, 2018 and going forward. Those are the new archive webinars there in the strategy section for spreads. Beyond the Basics Part 1, Beyond the Basics Part 2. Take that same search, same time frame, same monetary allocation of a portfolio, take out the stock criteria, and it failed. It was a losing track record. So the stock criteria is just as important as the option criteria in this strategy. Now, of course, what we found is we did the 85% probability because if I kept the same stock criteria and used a 70 to 75% probability looking for a 20 to 25% return, that lost over last year. But looking at an 85% probability or higher was profitable, where 70 to 75% probability spreads were not on the same stocks. Of course, it was a specific year, but we were trying to do it as a comparison about what works and what doesn't. We found these same results when we did it from 2015 to 2017, taking the Bull Put Weekly default searches against, hey, what if we look for lower probability and tried to double the return? I want both. Okay. So what you said here is you said you want a good probability. Let me scale this down. I'm just going to put in 80, which I think is still a good probability. But you want an 80-cent net credit minimum over a 5-point spread. Okay, so I can program that in specifically. And I also want maybe something that's in an uptrend that's going in the direction I want. Stock and SMA 20 over the 50, for example, or days MACD cross signals, what I might use. And then fundamentals not between now and expiration. Okay, so not worried about the return. I'm looking for a minimum 80 against 5. That's going to give me the return I want right away. We'll talk about that in a moment. Still want my probability. Oh yeah, and I'm going to want some open interest and at least some volume traded recently. Palo Alto, NASDAQ, and Alphabet. Okay, now the minimum 80 cents you had said on a 5-point spread, that's going to be about your 20% return. So rather than limiting it to 80 cents and 5 points, I could say I want a strike difference greater than or equal to 1, or we could just say any. And it doesn't have to be an 80-cent net credit. Let's just say at least 15 cents. But again, we talked about that. You mentioned a 16 cents against a dollar, 80 against a 5-point spread. You're at around that 19% return, right? That's what we're looking at, 19 to 20% return. Avoiding earnings between now and expiration stocks in an uptrend. IBM, wow, didn't expect to see IBM in there. Let me make one subtle change. Yeah, this could be 15. I'll put 15. That's your minimum requirement. I'll keep that. There we go. All right, Palo Alto again. Roku is in there. Okay, there's 49 total results. Be wary of 3 times ETFs. Okay, so what I was getting at is remember that the return is always going to be the net credit divided by the strike prices minus the net credit. The difference in strikes minus the net credit. So whether it's 16 against $1 or 80 cents against 5, you're in that 20% range. So you could just use that as your filter with the probability you want. I know it's not giving you the IV right now that you potentially want, but remember when we looked for the positions that had the higher IV, we saw Roku in there. EA Arts, of course, we saw they just had a huge drop the other day, and then they just popped back up. It was the makers of Fortnite came out with their earnings, and EA and the other gaming company was lagging, and then they just rebounded quickly with their earnings as well. Grubhub is probably more volatile. Also, let's see, where are we at? Yeah, so the short implied volatilities, a lot of these 0.4 on. Yeah, Eli Lilly I don't think is that high, but you see the Roku ones up here at 1.039. Oh, that's why, because it's the 3 times ETF. But you can see where the volatilities are as well. These ones are probably too low on Eli Lilly, but the other ones are probably, I just tell by looking at the numbers, they're probably in the range that you want as well. So that's something you might consider. Your return, your probability, avoid earnings, a little bit of the stock technicals in an uptrend. And as I mentioned, I will do my best to get the percent IV range in there for it as well. And Charles, as you mentioned, oh, okay, yeah, you can email your search to me. We'll follow up there. Both are relative. You want that higher IV to get the return you want, but I think you're going to be able to find the return you want, whether it's a 1-point spread, 2-point spread, or 5-point spread, just setting it in with the probability you want and a couple other metrics, and then we'll look to scale in the, more the IV, HV for the underlying and the implied volatility range. Okay. All right. So you can, oh yes, and you can always use that options research button when you find a spread. Yeah, the research there to go to the long or the short put to quickly see where it is. And those other webinars I mentioned where we reviewed about some of the search criteria and all, again, free webinars, option strategies, Beyond the Basics part, Credit Spreads Beyond the Basics Part 1. So we talk about the expectations, structure, trading plans, position sizing. And Part 2 was answers to questions of Part 1, how bear calls fared over 2018. This one here, Part 1. Not the Credit Spreads, the Basics, but Beyond the Basics Part 1 is I think where we compare what I just talked about with the bull puts, why the 85% worked, probability we looked for, but then we just lowered the probability or increased the return. It wasn't as successful with the same type of stocks. It's a balance there of win ratio to what you need in order to be successful. So take a look at that and send me your email with your search. Let's tweak that. Let's get it closer to what you want, and I'll get that requirement of my IV range and IV over HV that we talked about up on the programmer's list to get that into the credit spread searches a little bit more quickly if possible. I'll do my best there. All right. Okay, so that was related to the credit spreads for us. Good, good. Sam had commented earlier, going back to the Bull Call Debit spread positions and talking about the out-of-the-money Bull Call Debits we were considering. I'll just take Grubhub again as an example this time. So when we go closer to at the money with these spreads, we'll go 2 weeks out, 1 week out, I'm sorry. The 87, 85. So we're looking for more of a 1-to-1 ratio here as opposed to a bull put where I want that 80% probability. Here I'm looking for sort of a 1-to-1 risk-reward ratio. And Sam comments, the idea in the bull call is you're looking for small gains and you want the stock to move 2 to 5% and close the trade. You're not looking for a home run. So his approach to that is to say that, yes, I'm taking a 1-to-1 risk-reward ratio. I'm only looking to make 95 cents, but I might actually close it early without expecting the full return because I'm looking for a 2 to 5% movement in the stock to close this out with a 15 to 20% profit, whereas the bull put might be lagging because both options were out of the money and they're moving more slowly. Where in this case, this short is going to increase, but this long is going to increase as well. So a 2 to 3% movement, you might get out with a 15-20% return on the margin requirement and not hold it all the way to expiration. It's a more active way of trading. But this is part of the reason when someone says, well, if you take a 9-to-1 risk-reward ratio on a credit spread that's 7% out of the money, isn't it better to take a spread that has closer to a 1-to-1 risk-reward ratio? Well, the only way to structure a vertical spread that has a 1-to-1 risk-reward ratio is you're selling on one side of the stock and you're buying on the other side. Mathematically, you have a 1-to-1 ratio. Pretty close. The full profit to get the 1-to-1 ratio only occurs if the stock moves up above this strike, which is likely sitting at a 40 to 45% theoretical probability. And if the stock just moves down 2 to 3%, you're at full loss. Now it's only 1-to-1, so you say, I need one more winner to get back this one loss. But where is these stocks likely to be trading in the next 7 to 8 days? Somewhere in this range. You're looking at probably close to a 50-50 win-loss ratio long-term over the course of the year with this structure. As Sam says, his goal is not to make the full profit. It's to make the same 15 to 20% return you'd look for in a profitable credit spread, but trying not to take the 9-to-1 risk-reward ratio. But he's not making 1-to-1. He's closing this early, and he's actively closing these 2 to 3 times a week sometimes from what he said in the webinars. So it's an active trading. You're watching the screen a lot. And that might not match your trading plan. So you can say this is a 1-to-1 risk-reward ratio, but you're probably only going to be right 50% of the time. 50% of the time you're taking the full loss. 50% of the time you're taking, okay, let's call it 45 and 45, and 10% you're break even right in the middle. Why I'm bringing this up is that this is the constant battle everyone fights. Can you get a better risk-reward ratio on a spread? Yes, but now you've only got a 40 to maybe 50% success rate, where with this ratio I'm still at 88 to 89% success rate, and if I manage the 10 or 11% losers, I can still come out ahead. Here the movement is so quick I might not be able to manage the losers before I take the full loss. Again, as Sam mentioned, you're not looking for the home run. You're looking to close in this area to make 20% here, 30% there with a good move. You get a sudden surprise and you make 50% of what you expected to make. You're not making one every time you win and losing one every time you lose. You're losing one and making 20, 30, or 40 when you win. So you still need to be right more than 50% of the time in order to profit long term. That's sort of the trade-off. We'll have more information for you on that coming up as it ties into our spread series that we're doing right now. We've got a couple other thoughts to do on that, and you'll see invitations to emails for those spread videos coming out shortly. For a recorded one will come out next week for you, already recorded, and then you'll see invitations to live follow-up webinars on that credit and debit spread discussion beyond the basics and more coming out the following week after President's Day as well. All right, well, ladies and gentlemen, I do not see any other questions that have come in. I think we've covered everything that we wanted to there as far as the questions that came in, I should say. Just want to remind everyone, of course, that today's material is my thoughts on your questions, designed for educational purposes, increasing investing performance and knowledge, and of course using the PowerOptions tools to meet your needs. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk, which we covered a little bit of today, may not be suitable for all investors. If you liked what you saw with the search capability for the spreads, the naked puts, long calls, or the other 20-plus strategies that we support, or use of the portfolio tools, ideas on the management techniques in the webinars, remember you can take a 14-day free trial to PowerOptions at any time. Just put in your first name, last name, and email address at PowerOp.com and click Start My Trial Now. You'll have full access to the PowerOptions tools for 14 days, no credit card required. After that, the subscription levels start at $40 per month for end-of-day data. Most popular service, of course, is the delayed data at $60 per month. We do offer real-time service and full access to our over 12 years of historical data for options and stocks on the historical service or on the premium service as well. If you do think of any other questions later on, please send me an email at any time to support@powerop.com. And if you do have questions about the radioactive trading techniques, which we didn't get into today, you can also send me an email to support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. And remember, Anyone who's currently on a trial or is a current subscriber to PowerOptions, you can schedule one of those coaching sessions at any time. Well, ladies and gentlemen, thank you again for joining me this afternoon. Thank you for your fantastic questions and your ongoing discussion. Get this webinar posted for you, and I'll send everyone an email when the recording is archived. Have a fantastic weekend. I look forward to seeing you soon. Good night.